If you are not fairly sophisticated with respect to understanding both finance and DeFi, you should probably not be playing these games. These are really something that requires, as you can see from the storytelling, that really requires quite a bit of financial sophistication to understand what these products even are, what their risks are, and what to do when the game changes. If you don't really understand, if you don't understand what we were just talking about, the cost of capital and the risk-free rate and all this stuff, probably you are not going to win this game.
Not a dividend.
It's a tale of two Kwan.
Now, your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Unnamed trading firms who are very involved.
I like that ETH is the ultimate Ponzi.
DeFi protocols are the antidote to this problem.
Hello, everybody. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intros. First, we got Tom, the DeFi maven and master of memes.
Hello, everyone.
Next, we've got Robert, the crypto connoisseur and czar of Superstate.
Good evening.
Joining us today, we've got Guy, Giga Chad and economic evangelist at Athena.
Thanks for having me.
And I'm Haseeb, the head hype man at Dragonfly. So we're early stage investors in crypto, but I want to caveat that nothing we say here is an investment advice, legal advice, or even life advice. Please see choppingblock.xyz for more disclosures. So Guy, it's great to have you on. We've talked about you many times on the show, or talked about Athena, I should say, more broadly, many times on the show. But it's been amazing to see your guys' meteoric rise. We'll be talking a lot about that on the show, but we first want to start with one piece of news that has been catalyzing a lot of conversation on Twitter, which is the depeg of a stablecoin called USD0, also known as usual money. So usual protocol or usual money. Tom, do you want to maybe just give the best way to describe what usual money is? Just like
Sure.
at a high level?
You can think of it as sort of a fiat-backed stablecoin aggregator. So then allows people to sort of speculate on the yield, and there's sort of a compensation of usual token, which is sort of the governance token that sort of also sits alongside the yield. So specifically, I think it's a spicy week for stables. Part of usual produces this actual stablecoin USD0 that's intended to be a true one-to-one sort of dollar equivalent. It's backed by these other things. It also has USD0++, which is like this zero coupon bond that in theory should sort of trade as a proxy for people's expected interest rates over a 4-year term. So you lock up your money for 4 years, and then at the end of those 4 years, USD0++. So that's specifically what sort of all this drama was about this week. It's people love talking about stables.
So usual money gives you some RWA yield through treasuries, and they juice this yield by issuing their own token. Basically, just you can yield farm usual token itself, the governance token for the whole protocol, by locking up your money into this zero coupon bond. But they had this mechanic that for some period of time, you could convert the zero coupon bond for $1 and basically take almost no risk, right? The whole idea was that this was effectively riskless. And so naturally, what happens when you have this kind of no risk is you have people going crazy and doing some kind of looping. So they just get super levered and they try to juice their yield as much as they possibly can using the same amount of money. And then one day, usual money decided that, hey, it really doesn't make sense that this thing is convertible one-to-one at $1. There really shouldn't be a peg. Mechanically, this is supposed to be a zero coupon bond, which means that you lock up your money, you're taking some principal risk, and it's not principal risk, but you're taking some risk, and it's locked up there for 4 years until you can finally get all of your money out at the end at $1. And so one day they kind of kicked the stool out and decided, hey, guess what? You can get this thing out, but you can get it out for 86 cents.
I thought it was 87.
87 cents. Okay, fine. 87 cents.
Because 86 was the LTV on Morpho. And so it didn't insta-liquidate everybody. They set it to just above.
Just above. And so what that means, though, is that the people who were looping, who were repeatedly, sort of borrowing against their own assets and getting super levered, those people actually couldn't unwind their positions because everybody was running for the exits and being like, oh my God, I thought that this thing was super safe and I could get out whenever I wanted. Now, if I want to get out now, I take a massive haircut on this farming strategy that I've taken on. And this has just caused absolute pandemonium. So many people were stuck in their positions. Some of those people who were stuck, they were effectively locked into bad debt because the interest rate they had to pay on their loop positions was so high that basically this thing was almost certainly going to go to zero, just because of all they just couldn't get out from the massive they were sort of spun around a spindle with all the looping that they had done. And so this has just caused total pandemonium. Many people criticize them for this very weird messaging in this 11th hour, pulling the rug out. And so it's been, I think, something of a object level lesson in the importance of being really fucking clear about your mechanics and not changing the rules very suddenly, because crypto is kind of the home of moral hazard. If you even potentially aren't clear about what the rules of the game are, people are going to go all the way up to the cliff's edge. And then, of course, as soon as the tectonic plates start shifting, people are going to just get swallowed up into the abyss and yell at you all along the way. So usual money, I think they've suffered quite a bit in terms of both the reputational damage and then also just the fact that their community has just been hurt so much from the fact that so many people were given inaccurate information about what to expect in the way in which they're supposed to be playing this asset and the game that was constructed around it. So we stop there, get reactions. Robert, as somebody working in the, with Superstate and your experience running lending a protocol under Compound, how do you perceive this whole situation? And then Guy, I want to get your reaction as well.
Yeah, I mean, there's a lot of things that have gone wrong here that have, come together to make an extremely difficult situation. If you removed one or two of these ingredients, I don't think we'd have what amounted to be a somewhat small to medium crisis for a large number of users on, Morpho and Usual and, Curve and all of these other DeFi protocols that were tangentially affected. But at the end of the day, the root cause, in my opinion, is the fact that, there was not a clear set of rules about how the fundamental economics underlying an extremely leveraged strategy would change. I don't think anyone in the community expected them to change the floor price or implement a floor price. There was not a clear understanding that this is something that would go from a fixed conversion rate to a floating conversion rate. And this caught everyone off guard. They can say, oh, well, you should have known about this. But fundamentally, when the entire market is basing an economic strategy on what they think the rules are, to not say anything preemptively is a little bit of a mistake. To change the rules without warning is an even bigger mistake. And this all comes together with extremely leveraged users. And so, this was bound to happen. It's not the end of the world. I think their users will recover from this. Not that many people were liquidated, so they weren't like forced out of these positions. It's just a total bummer. And hopefully it's a really good learning lesson. Usual bounces back stronger. The users do too. Everybody learns from this and doesn't repeat the same mistakes in the future.
Guy, what's your take here?
Yeah, I think I have a small disclosure. I did do a small investment in Usual before they came out this year, and I think Athena's also had plans to work directly with Usual, potentially making some part of the backing behind USD0. So just wanted to make that clear. I think, echoing the comments from everyone else, I think the communication here wasn't great. Obviously, changing things pretty quickly without much warning, and I think there had been some mixed messaging around exactly how hard that floor at $1 was. And I think that there was some confusion, both with people who had been around the protocol as like private LPs for many months, and then obviously new retail users who came in later in the game. I think part of the issue here is a lot of the DeFi applications where you start to embed dollars or their product almost has the implicit assumption that this is a dollar. So when you're levering something on Morpho, it doesn't make sense to do that at 10x if you think that there is a real possibility that it's going to trade below 90 cents, in the next couple of months. Another example is Pendle PTs. The APY that you see displayed on their website, again, assumes that the principal is going to be the principal, and it's not going to lose a huge amount of the face value between the moment that you enter and the maturity. Curve pools assume that the two assets are stable and the values will sort of track each other. And so I think the issue in most of the complaints I've seen is actually that there are huge amounts of incentives that are actually pushed towards these different applications where they're actually incentivizing you to provide liquidity on something that's going to depeg eventually. They're incentivizing you to hold an asset that you think is going to be maturing with a full principal and isn't in the end. And I think that that's just where people got banned. I think the maybe general advice for people is that maybe just take a step back and think about, like, at a system level, it's a stablecoin backed with a bunch of T-bills that's paying 4%. And so when something's paying 60 all across the board, there has to be a zero-sum game that's going on somewhere, which is who's actually losing on the other side, so that someone's earning 60 out of a system producing 4.
Yeah, so let me just reiterate that for those at home. So this is supposed to be a stable coin that's getting T-bill yield. T-bills are paying 4%. But people who were playing the game were making 60% annualized, right? Which should be the first red flag. Okay, something is probably unsustainable about the situation. How can you be getting 60% for something whose underlying assets are paying 4%? And the answer is probably you're taking a shitload of risk. Now, that being said, Guy, I want to ask you sort of two questions about that explanation. So one, it's very common for stablecoins or any project in crypto to start subsidizing things early, trying to attract more TVL. Like this is not just normal; it's basically universal across all startups. Not even just in crypto. Is that you get some marketing spend, you give incentives, you try to get people in the door. What is it about the way in which they were spending money? You pointed to the fact that they were incentivizing people on Pendle. It's almost as though they were trying to get people to get super levered and to do some of this looping. What do you think they should have done in that regard to not have gone off the rails to the extent that it did?
Yeah, I just want to make sure. I don't think that they were doing this maliciously to push people into things that they knew.
No, that's not what I'm implying.
Yeah. But I do think it's basically just not thinking through the second order implication of when this starts to drift from $1, what starts to break further downstream from the core product. And these are permissionless systems, so someone could have always taken that asset, put it on Morpho, and started to do things with it. I think it's just when you as a team decide to actually start streaming rewards to a certain type of activity, there's almost an implicit sort of endorsement of the fact that idea makes sense, right? So I think if someone was doing something with USDE or SUSD on our side, and we thought that this was fundamentally unsustainable or something was going to break further down the line, we as a team wouldn't be, pointing incentives towards encouraging that activity. And I think that was just the piece which surprised people, which was if you had thought about these sort of downstream impacts before, you probably wouldn't have been incentivizing those types of activities.
So where should have they been focusing the incentives? Like, I mean, it's very common for people to do this kind of thing of putting incentives onto Morpho and onto Pendle and so on.
I mean, Ethena does it.
Yeah. We obviously did a huge amount of that to start with. I think it's just trying to grow the core product. I'm still not. I don't really fully understand why this zero coupon instrument needed to sort of exist. It's a T-bill. It's supposed to be one of the most safe and easy to understand sort of assets that exist. I don't really understand why there needed to be so many layers to the different pieces of the capital structure within usual, because I think that added complication here just sort of compounded the issues. Yeah.
Okay, so then and this idea that like, okay, they had this sort of redemption window that suddenly closed and they didn't really communicate when it was going to close or why it was going to close at the time that it did. Now, again, I want to rewind the clock a little bit because it's easy in hindsight to say, oh, they did this thing wrong, they did that thing wrong. But I want to make sure that, because there are a lot of founders who listen to this podcast, and I want to make sure we do something of a postmortem here, or not a postmortem because it's not dead, but like to try to understand how should this have been done. It's very common that projects will say, look, we're going to give extra rewards, we're going to give extra incentives, and we're also going to make it really easy and relatively low risk for early adopters to come in and say, look, you can get in and out of the yield-bearing asset in a way that you will not be able to eventually, right? So what do you think would have been the right way for them to have done this and kind of, sort of grease the inflows and outflows into the protocol? Would it have been for them to pre-announce the date of the removal of that floor price? Would it have been never to have that floor price at all and use different mechanics? What do you think, in retrospect, if they could play it back, they should have done to do this the right way?
Yeah, I think you can incentivize obviously just the core product, which I understand to be USD0, which is just the basic RWA-backed stablecoin. I think that there's no issues throwing incentives there if you want to bootstrap that from zero. I think it's actually just pushing the incentives on that secondary asset or like the secondary token that they have, which is the issue from my perspective. So yeah, I don't really think that there was a problem just pushing plain vanilla incentives on the core product. And, they would have had a growth period and slowed down whenever those incentives slow down, like any other product we've seen. I think it was that second sort of token that really caused the issue.
Not to get inside their head because I'm not a member of their team. I haven't spoken to them about this. I'm just guessing here. I mean, my read of the situation as an outside observer is that, this second product was really designed very clearly to lock up capital for 4 years, to lock up users for 4 years, to build a moat or a base or whatever you want to call it of assets that wouldn't go away, right? It wasn't, there's a reason why it's a 4-year, product, and I think in their minds, most likely they were trying to establish permanence in response to a lot of the arguments about token incentives and yield farming and airdrops and all of this stuff, and that it's mercenary capital that goes away. And so, I assume that they thought this was just like a brilliant way to take the other side, which is, well, what if we just lock up the users for 4 years? Then we don't have to worry about mercenary capital. Like, it allows us to change the incentives later. And I just think it was an experiment that went a little haywire.
I think there is that component where, in some respects, reminds me a little bit of when Maker had that sort of emergency fee hike. I think maybe it was about a year ago, and people were complaining that it was too much too soon. And it's kind of like when you're a protocol and you realize that the protocol is doing something uneconomic and it can kind of threaten the entire system. It's like, okay, do you take action immediately and potentially cause market chaos, or do you do something gradually that hey, maybe actually causes you to you lose out net more than taking something immediately, but like ultimately allows sort of a more gradual unwind of the process. And like, I don't know if there's actually a clean answer or one is better than the other. It's either you're taking the loss or users are taking the loss. But if you as a protocol take the loss, there's also a risk that, hey, there is some sort of bank run Minsky moment, like something does collapse, and then you have sort of a broader, it's sort of like, do you do a total protocol freeze and then sort of give everyone some sort of haircut pro rata, or do you like let the protocol do its thing and let people just sort of withdraw? And if you're stuck, then you get a zero. I think doing some sort of like haircut effectively is probably a better option.
Yeah, I think the weird thing about this whole story is that the underlying for usual is actually a pretty boring product, right? It's supposed to be a boring product. It's fucking T-bills. So the financial alchemy required to make T-bills this like crazy yield farming, loop-de-loop like roller coaster, requires there to be a lot of risk and craziness somewhere, and the fact that users were not able to really clearly perceive where that risk was coming from and the nature of that risk, like it's look, on some level, the whole spirit of crypto is caveat emptor, right? As long as you put the smart contracts out there and the code is clear and the disclosures are there, then have at it. And if you end up getting hurt, like, look, at least you knew what you were getting into. The place where this all rubs people the wrong way, and I'd say it's true for me as well, is when there's humans involved. And the humans are the ones that are ultimately making people get hurt. If it was in the rules, if it was like, hey, this redemption window where you can convert USD0 plus, or sorry, USD0 to USD0 plus plus, if that redemption window is going to be live for exactly 90 days. In the first 90 days of the protocol, you can get in and out and you can do whatever craziness you want. But then like, as of this date, it closes. Then people can plan around that. People can actually foresee what's going to happen. But if it closes one day suddenly, then you are absolutely going to create these like really violent situations in a market. And those are the places where people, if people know the rules in advance and they get hurt, they at least know, like, look, I'm an idiot. It was my fault, or at least it was a dynamical system that, okay, maybe I should have foreseen what would happen. Maybe it wasn't obvious that people would run for the exits at this time, but if I had done my homework and I thought about it more deeply, maybe I could have anticipated it. But you can never anticipate a human coming in and pressing a button, and that's, I think, the thing that really pisses people off.
Yeah, I think that's right. I think one of the pieces of interesting commentary and interested in your views on this as well was people sort of trying to determine what is actually the floor on this now going forward. I think there's a lot of commentary on there being, a mathematical floor for this thing in the high 80s, because if you discount 4% back 4 years, that's sort of like the current value that you get. I think if you strip away all the tokens, though, there's a very interesting question, which is how much would you actually have to get paid to lock up your money for 4 years in crypto? And most people's cost of capital is not 4%. And I think that, I don't know where that sits on this call, probably somewhere between 15 to 25. And when you run that maths, like that should actually be trading at like 40 to 55 cents if you're assuming something that's as wide as that. So I think that's just one of the pieces for people to think about, which is if you strip away these token incentives, this sort of idea that there's a hard floor, at a 4% discount rate, I think it's just something that people should think through.
Yeah,
Well, this is a hard floor that they introduced, right? This is not
they
like the market quote unquote floor. Yeah, exactly.
Yeah.
Right. And, you know, not to get too bond math geeky on this conversation, but, you know, the formula to find the present value of it or the expected value is not based on the risk-free rate or the T-bill rate. It's based on the required rate of return. And to Guy's point, you know, in crypto, what do you require on a low-ish risk investment, right, to enter into it? And it's definitely not 4%, right? It's probably closer to that 15% number. And, you know, what's interesting about this is that, like, we haven't seen the market understanding that or pricing it at all, even after the fact. Like, when you go on Twitter, people are like, oh, like, here's the formula. I Googled it. Like, you know, it's, you know, 1 over, you know, 1 plus 0.04 to the 4th power. So, like, it should be 80 something cents, you know? And the widespread understanding is that, you know, the required return.
Yeah, the reality is that that interest rate arbitrage is only possible if people with that cost of capital are on chain doing that interest rate arbitrage, and they're obviously not.
And the required rate of return is not going to be the risk-free rate because it's not a risk-free investment. There's smart contract risks. There's rule change risk. You know, there's all sorts.
As we've already seen.
As we've already seen, I would actually call it, you know, 1.5 times, you know, no risk. So, you know, take for that what you will.
Yeah. So very interesting situation. And it's another one of these examples in crypto. You know, I imagine many people who aren't in the DeFi trenches every day, they hear about this and they're just like, oh my God, another stablecoin that depegged. Aren't stablecoins just, isn't this just a, you know, just, I don't know, just like a fucking disaster all the time? Isn't that all I hear about in crypto? And so I guess it's worth reiterating. For one, USD0 was a pretty small fledgling stablecoin. It was obviously kind of in its first innings. And the second thing I'll say is that if you are not fairly sophisticated with respect to understanding both finance and DeFi, you should probably not be playing these games. These are really something that requires, as you can see from the storytelling, that really requires quite a bit of financial sophistication to understand what these products even are, what their risks are, and what to do when the game changes. If you don't really understand, you know, if you don't understand what we were just talking about, you know, the cost of capital and the risk-free rate and all this stuff, probably you are not going to win this game if these concepts are alien to you. That's the first thing that I want to say, is that this is very much the deep end of the pool of DeFi insider mechanical stuff. Now, I want to take that as a backdrop and come to Ethena. Because Ethena, of course, playing at a very different level of the game, playing, first of all, you guys have been around for much longer, but also you guys have been one of the massive success stories in DeFi. Now, part of being a massive success story means you also have your detractors, and we're going to talk about that too. And I also want to caveat that, of course, you know, we being Dragonfly are investors in Ethena, but we also want to understand the role that Ethena plays in this DeFi financial universe because it's a complex one. So first and foremost, I just want to give some high-level numbers on Ethena. Ethena is the second fastest protocol to hit $100 million in annualized revenue. It's the fastest US dollar asset to hit $5 billion in supply ever. And it accounts for right now about 85% of all on-chain USD growth outside of the big two, which are USDT and USDC. So Ethena has been a massive success story on chain. Now you don't describe it as a stablecoin, you describe it as a synthetic dollar. And we've talked about it on the show before, but I'd like for you, Guy, to explain mechanically what is Ethena and how does it work? And then we'll talk a little bit about the Ethena roadmap.
Yeah, sure. So the genesis and real origin of like the story goes back to that article that Arthur Hayes put out at the beginning of 2023. So it's his original idea, and I think we saw two similar projects actually to Ethena that existed last cycle. But the basic idea here is that you're taking in some form of crypto collateral and then using derivatives to hedge that collateral, which allows you to issue a synthetic dollar and synthetic dollar on the other side. And really the core idea here is that when you're using a future or a perpetual swap to hedge out the delta of the actual asset, the movement in the price of the underlying doesn't actually affect your ability to maintain the solvency of that dollar that you just issued. So yeah, at a very basic level, that's what's happening. And one of the interesting byproducts of what I just described there was that when you're short futures or perpetuals, there's a very interesting interest rate that's produced within crypto, which is known as the funding rate. And I think that that's really the core what's driven the massive, I think, interest and growth within Athena, which was this was a relatively untapped piece of the market where really you can think of Athena as, importing that really huge basis market into DeFi, which sort of enables other people to build new interesting financial products on top of that. And then, eventually try and actually take that and export it out of crypto is the vision of what we're trying to do next year.
Sure. So let me reiterate that for those in the back. So what Athena is doing is they're tokenizing what's known as the basis trade. The basis trade is one of the oldest trades in crypto. Literally, people have built funds around just doing the basis trade. It's not a super complicated trade. Basically, what you do is you go long and you go short. If you're both long and you're short in some asset, then that means that you're hedged. That means that, whether the asset goes up or asset goes down, you don't really care. Your position is going to be worth $1 and it shouldn't move. Now, when there are more longs than shorts, as there are most of the time in crypto, because most of the time crypto wants to be long, then you get paid interest on being long, and that's known as the funding rate. And basically, Athena, what they do is they're long and short by being long the spot and short the futures or short the perpetual swaps, and they collect a funding rate in times when there's more long interest and short interest. And this funding rate is the yield. That's the quote unquote yield. So where USD0 was getting their yield from treasuries, Athena is getting their yield from basically the demand from crypto markets to be long. Or another way to put it is that it's the demand for capital. When crypto as an industry doesn't have enough money, essentially that's what they're doing is they're bringing more capital into the crypto industry to do what crypto industry wants to do, which is to play the crypto market. So that's a very high level representation. Now, one thing to understand, I think a lot of people are somewhat confused by the funding rate is floating, right? It's not like treasuries. Treasuries always pay 4% or whatever. The funding rate goes up and down. Sometimes it's positive, sometimes it's negative. Talk to us about, okay, when should we expect the yield on that you're getting from the funding rate to be positive versus negative, and what are the mechanics there?
Yeah, I think it's really linked to what you're describing there, which is the demand for leverage within the system. So when the market wants to express a particularly bullish view, there's just generally a shortage of dollars to actually supply capital into people who want to express that on leverage. And so, yeah, all that number is really representing is how imbalanced the demand is for longs versus shorts. I think the moments that you've seen this peak the most, as you expect, is sort of peak froth within the bull market. So 2021, we saw those rates average like north of 30, 40% consistently for months in the first sort of quarter and then the back end of the year as well. And I think the two events which really drove high funding rates within the last sort of 12 to 18 months was really around that announcement of the BTC ETF, where everyone realized I need to front run these like real spot flows that are going to come. I need to get long more than 1x my sort of position on BTC. And we saw the same thing around the period with Trump to a slightly less extent than what you saw with the ETF at the beginning of the year. I think one of the interesting pieces, though, and sort of chatted to a few people around this, was the funny thing about the funding rate is that it's actually the moment you least want to be in dollars is actually when the funding rates are the highest, which is there is actually a reason for why the funding rate is so high, is that there's such broad consensus that crypto assets are going up so much. And so it's actually a perfectly rational thing to do for people to pay 30, 40% interest if you have a very strong view that Bitcoin's going to double between now and the end of the quarter. And if you just sort of backtest through time, the periods when funding rates were the highest and Athena's product is like on paper as attractive as it can possibly be, that's actually when you want to hold no dollars and just be 100% long crypto. Yeah.
Right. So if you hold Athena's synthetic dollar, you're getting exposure to the funding rate. And so when the funding rate's high, you're getting a high yield. When the funding rate goes down, your yield goes down.
If it's staked, right?
Yes, correct. Yeah. So there's two tokens within the design for Athena, and that looks very similar to the way that DAI and SDAI or USDS and SUSDS is now constructed. The way we sort of thought about this is that you have two real use cases that you're trying to serve here. One is sort of a unit of account, something that you're using for trading, and an instrument that's less of like a savings tool, and that's like USDE, which broadly approximates $1. And then SUSD is where you're taking that to stake and then actually capture all of what we've described there and a small amount of staking yield that comes from the ETH collateral. And really, we've just tried to bifurcate between what are the two use cases that we're trying to serve here, which is sort of trading and money, and then more of a savings tool that sits on the side. And I think where Robert's going to get to there is you've got the yield amplification stuff.
Yield amplification, which is my favorite mechanism of 2024. Congratulations, Guy and Athena. I think it is an absolutely wonderful and brilliant mechanism. And I think it's going to be widely adopted by other projects. I think Usual, in a sense, is also taking that mechanism, but I think we're going to see that, strategy get used as a basic building block of DeFi over the coming years.
Yeah, I think one of the interesting things there was that sort of MakerDAO was actually doing that, not as explicitly as a sort of a strategy to bootstrap what they're doing. It was just more that the product construct drifted through time when they introduced SDI. One of the most interesting stats that I actually heard about Maker, I'm going to misquote the absolute numbers here. It's somewhere between $1 to $2 billion of DAI is sitting in an EOA which hasn't actually moved for more than 24 months. So if you just look at the analysis of the wallets that are actually holding DAI, there's a huge amount of this dead capital that's sitting within Maker. Because if you look at how much DAI is actually being staked within the staked version of Maker, I think last time I checked, it's like sub 40% of the total. And you really ask, why is it that so many people aren't capturing this relatively low risk 12% that they're paying at the moment? And the answer is that there's just huge amounts of capital that are stuck in, old curve pools from 2020. There's Uniswap pools from 2019. And just having existed for that amount of time leaves all of this dead capital that's sitting there. Why that's so powerful for Maker is that you don't have to pay an interest rate on that. It's almost like a 0% deposit that's sitting with Maker that they can pick up and put into Ethena and try earn something that's north of 20 in some periods. And that's really risk-free, interest expense-free capital that they can sort of use to either generate more profit or choose their own product. So that was just an interesting fact that I didn't know about Maker, and it's a pretty powerful moat that they have going forward. Yeah.
Okay, so I want to take a step back because we've gotten very deep into some of these wonkish DeFi, sort of inner workings conversations. I want to ask the big question of okay, so what? So you guys are this way to get exposure to the basis trade. People like the basis trade yield. It goes up and down. Who gives a shit? Why is this such a big deal that why is Athena so fucking big? Why do people care that much about this asset?
Yeah, I think the simple answer is that a dollar with some sort of return is really the most basic financial asset on earth that I think everyone could potentially want to use at some point in time. I have a pretty strong view that outside of Bitcoin, it's actually really a product like this that really only stands a chance to get in the hands of 1 billion people, which is if you just go around the world, what is the one financial asset or function that you're wanting to get out of the financial system? And it's really you just want to hold $1 in your bank account, get a yield, and then potentially spend that. So I really think that the demand for a product like this, if you can do it at scale and really produce a structurally higher return on capital, is just orders of magnitude larger than where Athena is now. So I think that's the reason why people care, which is the demand for dollars, as we've seen with the success stories of stablecoins in general, is huge. And I think if you can produce an interesting sort of return on those dollars, the market there is even bigger. And I think the question here is really how much can the crypto market absorb in terms of demand rather than how much
what's
demand.
the constraint?
Yeah, exactly.
Well, let me lightly challenge you on that one statement. I would posit that the demand for a stable transaction-based currency, one that's designed to be used in trade, used in settlement, used in all the different use cases of payment flow, people would prefer one that's backed by the simplest, most boring stuff possible, right? If it could be $1 not in T-bills, I think people would prefer that. If the simpler, the better. And so the question is, do you think that the dollar component, not the yield amplification, amazing, gets all the income from a really high yield strategy, that part I get, right? That part I think there's a crazy amount of demand for out the wazoo. But the other side of it, the stable side, the transaction side, is the demand for the transaction side, do you think, higher if it's backed by a high yield strategy, or what Tether and Circle are doing, which is a very low risk strategy?
Yeah, no, I think you're exactly right. The demand and use case for that dollar without that is definitely smaller. I do think the one piece I'd maybe just encourage people to think about, especially within crypto market structure, is that often that decision is not made for you. It's made by distribution platforms like centralized exchanges. And so you don't actually make the decision of what stablecoin you're using on those exchanges. They make it for you, and they allow you to sort of trade with it. And so the way I maybe sort of flip that around is saying, in an end state, if we assume that Athena can sort of grow from where it is now, is an exchange more incentivized to push Athena's product onto users rather than something that gives them no return, Tether is internalizing all of the sort of profits to themselves, or is something where they can actually make quite a lot of money embedding what we're doing into their platform, actually something that they're more aligned with. I'm not saying that every user on Earth is going to abandon fiat stablecoins for what we're doing, but I think the incentive structure here is much more aligned with what we're doing, so that in an end state, they might make that decision for users.
Yeah, speaking of risky backing, I mean, I still remember crypto capital and all the stuff about Tether holding a bunch of Chinese commercial paper that
I remember
potentially
that.
was going to go up in smoke. Yeah, exactly. So it's I think it's a very good point and also a very apt history lesson that it wasn't always the case that people assumed that Tether had robust backing. Obviously, it's a very different story today, so many years later. But it underscores the point that distribution is so much in crypto.
Well, that was the primary argument against Tether, to be honest. Like, I've been around for a while. Like, the primary argument against Tether was you don't really know what's backing it, and it's higher risk than, you might want. And I think most of the world didn't care because I think they had a distribution advantage, especially outside the US, and an adoption advantage. And at a certain point, people just said, like, well, it has more liquidity and more market share than any other stablecoin. So that's the one I want. And they've been very fortunate with that. But I do think
in Asia, a big part of the reason why people like Tether is because it's not American.
Right.
Is because it stood very cleanly outside of the complex of the, sort of American government, law enforcement, asset seizure regime. Obviously that's changed now. Tether is actually, if anything, more freeze happy than Circle is, which many people don't know.
Freeze happy, yes. They'll stop frauds and hacks extremely quickly and aggressively, whereas Circle doesn't.
Right. I mean, they do, but just not as quickly and not as frequently as Tether does. Anyway, let me come back to Ethena. So let's talk a little bit about that constraint, because I think once people understand the mechanics, they might say, okay, great financial product, totally understand why you want that. But if you think about understanding Ethena, okay, Ethena is long and short. They're long the spot, short the futures. You can be infinitely long the spot. You can be long spot. You can buy as much Bitcoin or Ether and be super, super long, but you cannot be infinitely short, right? There's just not enough liquidity on the market for you to be infinitely short. So how do you think about the growth potential given that constraint on the crypto market size?
Yeah, I think this is actually one piece that I got wrong in our expectations, even from when we were chatting like 12, 18 months ago. I think the interesting piece that we've observed this cycle and last is actually that the derivative market tends to grow much quicker than actually underlying market caps and prices. So what we've seen was actually that BTC, even just looking at this year, the open interest climbed at roughly a ratio of like 1.5x versus the market cap itself. And so as the market's actually growing and asset prices are expanding, the derivative market is actually growing at a quicker pace. The reason I'm giving that context is that actually, despite all of those figures that you've just put out around Ethena, we shrunk relative to the market between April and the back end of this year. So we actually got smaller as a percentage of the market. And that's just because things were growing that much quicker. So I think where we stand now, I think the funny thing was actually when I was pitching Ethena to you guys, I sort of viewed 5 billion as like the crazy end state of how big this could get in 5 years' time. And we sort of got there in a year. And sitting where I am now, I think that number's like 20 to 25 billion, even if we don't see like material growth in the size of the derivative market going forward. Really, I think just expressing it as a percentage of open interest is the way that we think about things. We're roughly sitting at 7% of the market right now. I think we could represent 20 to 30 without fully distorting, the market as it is right now. The other way I've sort of encouraged people to think about this is actually less of around what is the dollar notional that Ethena can get to, but more what is the clearing equilibrium interest rate that someone wants to hold the asset in an end state. So I'm sure we can jump into it, but I think the plan for what we're trying to do this year is actually trying to take the asset and push it into TradFi, where the cost of capital is just that much lower than where it is within crypto right now. And I think the way that they're going to look at things is I'm willing to hold USDE at risk-free plus 200, 300, 400 basis points, and I have an unlimited amount of capital to push into it until funding rates go from where they are now to that spread to risk-free rates. And that's actually kind of the mechanism that I think people should think about Ethena, which is we're trying to solve for like an interest rate of what should be the cost of capital within crypto for this product. And actually the supply of USD is just a balancing item that's getting us to solve for that.
Okay, so before we get to the roadmap, one more question that I want to zoom in on is where the assets live. And so it's sort of the custody as well as the venues. So you mentioned that there were a couple predecessors to Ethena. So obviously, Arthur Hayes wrote this piece, Crust on Dust, I think it was, where he described the mechanics behind this asset. But actually, there was some prior art, and actually one of them Tom invested into, called Lemma Finance, which was originally doing a version of this, but they were doing it all in DeFi. And this was, Tom, when was this? This was like 22?
It's like 21, I think, even. But
21.
Into 22. But even before Lemma, there was Value, VALIU, that was doing this in LATAM before stablecoins were really big and offering sort of a dollar savings account. So it's an idea that's been around in crypto for a while, but has struggled for one reason or another to really hit mainstream adoption.
Right. And so the difference, and I think, it's kind of one thing you guys correctly identified in that idea maze of ways in which you could potentially build this is realizing that you had to go to CeFi. You had to go to centralized exchanges. You couldn't just stay in DeFi because the open interest was just way too small. And you couldn't really build anything that could get to the scale it needed to be potentially competitive with other dollar-denominated assets. So talk me through, how do I understand the venues and the custody of the assets that go into Ethena?
Yeah, so this is a pretty big change in like market structure versus last cycle, where we saw the emergence of this piece of infrastructure called off-exchange custody, where you could essentially house the actual collateral outside of the centralized exchanges themselves. And what that enabled was your ability to disaggregate custody from execution and settlement on the exchange. So this is something that didn't actually exist last cycle. It was something
this is like a post-FTX thing.
Correct, yeah. And actually post-FTX, I'd been designing the Ethena product going into the FTX event. And then FTX happened, and I was like, okay, there's literally zero way that you can leave assets on the centralized exchange in crypto going forward, and had to go back.
Good insight. I will give you props for that insight.
Yeah. And so, yeah, I personally didn't feel comfortable putting things directly on exchanges. We saw the emergence of these off-exchange custodians, and I think that was just very good timing as we're thinking about this product to come out, where we could really leverage that to, I hope, give users more comfort around that particular risk. But yeah, I think the quick summary here is that there's not a single dollar of collateral within Ethena which actually sits on a centralized exchange. That does not mean that the risk is zero facing these exchanges. So you still have the hedge that is sitting on the exchange, and to the extent that you have unrealized P&L on that venue and one of them were to go down, there is a risk that you wouldn't be able to recover that full unrealized P&L. What I would say, though, is that sometimes we owe the exchanges money rather than the other way around. And so it's not necessarily, the case that if an exchange goes down, you're necessarily in the red, but it's most likely going to be the case. But yeah, I think that was a huge piece for us to just try and, address some of that concern around credit risk for exchanges.
Yeah, I would posit that it's definitely going to happen when things are going off a cliff, right? It'll be the next FTX and everything's going to be blowing up, and, exchanges go down in the bad times. They don't really go down in the good times. And so, as a book that's long spot, short perp, the short side is the one that keeps you safe. And so, I would say that it's probably not 50-50, in terms of the outcome of that coin flip. I would assume the coin flip itself is very rare. I think it's unlikely that exchanges in this modern era are going to go down. I think we've come so far. The standards of users are higher, the standards of regulators are higher, the standards of people running businesses are higher. So I think the odds are actually
we are proof of reserves, and we have all that stuff now post FTX that's become market standard.
Yeah, I think, but if it does happen, I don't think it's a coin flip. I think it's like 99.9% likely that, it's the wrong way.
Yeah. So let's then talk. One last thing is, so there are many situations. That's obviously one of them, but that's, more black swanny because you guys aren't on a ton of venues. It's not like you guys are on, every exchange. But what happens when the yield goes negative? So that we know happens with some regularity. It's not super common, but it does happen, right? Crypto has periods where people want to get the hell out and they're running for the exits. When the yield goes negative, how does Ethena stay solvent?
Yeah. So again, I think this is another piece that I took on the market feedback that we had when we first came out and slightly redesigned the product from its original version. So I think the mistake I made in the beginning was trying to do a purely crypto native backing, which was saying, like, in all circumstances, would be holding those positions of the cash and carry sitting in the backing. The much easier answer is that you close the positions and just sit in another form of a stablecoin in the event that does happen. And so I think that I read the market wrong, where I thought that they wanted that crypto native element to it more than they wanted just a very simple answer of like, we're going to close the positions and sit in stablecoins. But yeah, I think to answer your question more directly, even in the event that you're closing those positions to sit in the stablecoins, we do have a reserve fund that's sitting behind it, which is roughly 1% of the total assets. And in the event that isn't sort of sufficient, there would be a pro rata sort of reduction in the collateral that's behind USD. I think the interesting piece about this one is that I've obviously spent many hours talking about this risk around the funding rates, and to me, it's the one I'm like the least concerned about, but I think the one that people speak about the most. And in the event that something truly disastrous did happen where you're sort of bleeding out, you can swap into stablecoins for whatever reason, whatever it is. I would just mention that it's like an extremely slow attrition of principal rather than like you wake up and you've lost 50% of your principal in a zero coupon bond the next day. And
oh, damn. Okay. Shut
Zing.
So yeah, I've just sort of contextualized that element around it. Yeah.
Yeah. Just to add on to that, I mean, the correlation that works in your favor is if the funding flips, it's because, you know, the perps are trading at a discount to the spot. And when you are closing out those positions, you know, you're doing it pretty favorably, right? You're literally, you know, actually making a small gain as you close them out. And, you know, as somebody who participates in this basis market, Superstate has a product that's a cousin of Athena's, which is USCC. You know, I'm familiar with how that works, and I'm confident that Ethena could, you know, you could very easily close positions out quite easily if perps are trading at a discount to spot. Like, it's kind of the best time to be closing.
I think the one other element here is that all of this analysis sort of assumes a static response from the users as well. And we've seen this play out in real time with Ethena, which was, you know, we grew from 0 to roughly 3.6 billion in like 4 months. And then the market cooled off and we unwound about 30% of the supply to get down to 2.4. And that was exactly the mechanic as it described, which was when the rates start to come down, users start to decide, I don't want to hold this product and I want to go into something else. And it actually has like a self-correcting piece to that, which is when they're saying, I want my money back and they redeem from Ethena, you have to close the shorts, which actually helps to push funding rates back up. And so I think that this is one thing where people used to, you know, speak and compare us to Luna, which I obviously think is completely incorrect for a bunch of different reasons. But actually, Ethena is like almost anti-reflexive, which is like the larger it grows, the less attractive the product becomes. And then on the way down, it actually helps to, you know, resolve itself as it sort of unwinds, which is, it was literally in terms of like the design there, I think like, you know, very different to the reflexive piece that you saw within Luna.
Right. Luna being a negative feedback loop, whereas Ethena being the opposite loop where it neutralizes itself.
Yeah, it's sort of like equilibrating. Whereas, yeah, Luna sort of can't contract, right? That was the problem with Luna, is that once it got really big, there's no going back. Right? You have to be big forever.
Inflate Luna, sell Luna, Luna go down, problem worse, instantly collapse in like 2 days.
Exactly. Yeah. Okay. I think we've given a pretty fulsome picture of what Ethena looks like and why it works and why people find it a compelling product to hold. Tell us about the roadmap. What are you guys planning to do with Ethena? Okay, you've got this thing. It, you know, gives you yield. Okay, la-di-da. Where are we going?
Yeah, I think on the core product itself, the way we've always tried to think about the 3 different markets is sort of splitting it between DeFi, CeFi, TradFi. I think we covered off DeFi reasonably well when we came out. So integrated with most of the major protocols that you see on chain now. I do think there is some growth still left there. I don't think it's in the order of sort of like $10 billion for something that looks like Sky or Ethena. But I do think like on the margin, you might have seen something that came out today where Sky is going to be allocating another $1 billion into Ethena directly in terms of its backing. I think that this general dynamic that you see of rates coming down in the real world, crypto rates picking up, just makes the product of Ethena a lot more attractive to sort of sit within DeFi and a bunch of different applications. And I think that trend will continue through this year. I think other use cases that you've seen on Aave, that's been very much constrained in terms of the size that it can get to. I think that market could be north of $5 billion just by itself. And so I think that there is some growth within DeFi. That's not going to be the sort of $10 billion opportunity going forward for us. I think one really interesting use case that we saw emerge was as collateral on centralized exchanges. So I think to the discussion that we're having, earlier around centralized exchanges are really the key distribution avenue for dollar issuance within the space. And unless centralized exchanges want to push your product, you're not going to win like the game of being a stablecoin or a dollar issuer. I think people also don't understand how big the market actually is for collateral trading derivatives within CeFi. So, Tether, roughly 30 to 40 billion, depending on when you look, of Tether supply is used exclusively to margin perpetuals on exchanges. So that's literally the size of USDC, is just for that one use case that I just described there. I think for Ethena, that's actually an extremely compelling area that we can actually compete with them, which is, do you want to get paid zero on your collateral, or do you want to get paid something? And that capital inefficiency piece is just huge for the largest trading funds within the space, for them to, if you're trading $100 million per book, to give up $10, $20 million of income on your collateral side. It's something that you can't really ignore. And it's a product that they sort of understand from a risk perspective. So we rolled out that with Bybit, probably being the most successful example. We flipped USDC balances sitting on Bybit within just a few weeks. And I think for us, there's still a few new venues that we want to get onto and really push within CeFi. And then I think the biggest opportunity of all is really thinking about this more as a product that we can start to push within TradFi. And so I put out like a roadmap piece a couple of weeks ago, which just outlines how we think about, potentially taking this product and actually wrapping it up in an institutional friendly regulated wrapper that can actually go direct into TradFi. I think the interesting piece here, and we obviously touched on it earlier, is that because the cost of capital within TradFi is that much lower, Athena's product looks kind of interesting relative to other things within crypto. It's like, okay, high teens return, but I can go farm whatever thing on chain. And oftentimes you can actually beat Ethena with something else. But I think if you just compare, if you try and express it as like a Sharpe ratio or like the volatility of what Ethena is doing relative to the return, it almost looks like a scam to people who are sitting within TradFi. And I think that the next step for us is actually just plugging directly into those pools of capital where we can play out that sort of idea that I described, where they price it as a spread to risk-free rates. Yeah.
Tell us about, so in your 2025 roadmap, you described sending and spending SUSDE, and you also talked about the way in which you want to see Ethena become more like BNB and sort of be the token of a broader ecosystem of products. Talk us through some of that.
Yeah, I think on the more on the retail side and that Telegram piece that I touched on, I think we also just wanted to, I think, diversify the user set that we have. So a lot of the people using Ethena now are like mega ETH whales like Robert sitting on chain doing these like loops on Aave and stuff like that. And I think that there is another user base that we want to touch, which is just low balance users who are using this as their sort of like savings account. I think I gave you the whole thesis earlier around why I think that this is genuinely a product that can touch the hands of 1 billion people. And I think the reason that Telegram is so interesting is that you have immediate distribution to those 1 billion people like there. I think the DeFi ecosystem and all those different pieces on Ton is definitely pretty early stages and quite nascent. But I think the most interesting opportunity there is that actually within their custodial centralized wallet, you basically only have the option of Tether and Ton at the moment as the assets that you can hold. And I just really think the idea of having a single token, which almost represents a mini, Revolut neobanking type experience within your app, where you just hold a single asset that's, earning you a yield, and then you can double click on your Apple Pay and then spend it on the other side. That to me is like 95% of the things that I want to get out of finance as like an individual. And you can have it there sitting as a single token within your messaging app. So to me, it's just a product that I'm excited about that I think can genuinely touch the hands of like many users who exist outside of crypto. And I think, people are still underestimating how big that distribution from Telegram can be. It's 5 times the size of Binance in terms of the users that are sitting on there. So that piece I think is very interesting. And then, I think to your question around how we think about the ecosystem, this is just another piece that we wanted to try and evolve from our perspective into something that looks a bit more like a platform that other people can come build on. I think all the best protocols projects within the space always have to move at one point from we're just doing one product or a single asset issuer into something where you're trying to like breed more innovation on top of what you're doing. Whether that's an L1 or, I think actually Lido and Eigenlayer is like a really good example here where functionally it's kind of similar what they're doing, right? They're saying put ETH in the staking contract, but Lido had a single asset that did that, but Eigenlayer turned it into an idea that sort of had a lot more innovation and new builders wanting to come and build on that idea. I think the view that we have is that, $1 a dollar is sort of like the most important asset that flows through all of these DeFi financial applications. And I think you can see that in the way that Athena's actually touched and influenced all of these DeFi apps, whether it's Pendle, Sky, Aave, whatever it is. It's really sort of become a core asset in the whole of DeFi. And there's just a lot that has not been built on this new core asset that we want to see built. And so really what we're trying to do there is just incubate new applications that can help sort of drive growth of USD going forward. I know we touched on the Luna comparisons before, and I want to do that as little as possible. But I think one thing that they actually did pretty well, which I think was a good landing, was that actually they took a look at the asset and the core product, and they said, how can we build an ecosystem around this? And what are the core app ideas that actually make sense to try and grow the demand for this thing? And can we actually try and be a force that pushes that ahead? And I think that's one piece that we're just trying to, push ahead on our side outside of the core product.
Do you guys really aspire to be the next Luna? If I can summarize what you said.
Haseeb is going to meme that into existence in this show.
Okay. Amazing. Amazing.
Maybe we
That's
cut that
inspiring.
No, there's no edit.
No editing. That was perfect. That was perfect. No, I'm obviously talking shit. Let's we're coming up on time. And so one aspect I want to get to, Guy, if I'm not mistaken, this is your first startup. Is that right?
Yeah.
First time founder. Okay. So I have to imagine that actually just building something like this that the kind of takes the world by storm and grows at an absolutely fucking insane rate must have been incredibly bizarre and stressful. What was like for you? What kind of most surprised you about what it's like to see something go into hypergrowth like this and just become like just the center of the spotlight for an industry?
Yeah, the honest answer is I haven't actually had time to really pause and like think about it deeply in terms of like what's happened in the last year. I think.
Okay, well here we are. We're pausing right now.
Do it on the shopping block.
Yeah,
that's right.
I think it was something I referenced earlier. I think I'm continuously surprised, especially within crypto, just how fat that sort of right tail of outcomes can be. And I think you can always sit down and think, this is the upside and this is where I think we're going. But you can always be surprised, I think, just how quickly and how flat and wide that actual outcome can be. I think one of the interesting things about doing a startup is that it's almost one of the most like arrogant things you could ever do in your life, right? You sort of have a view of the world that is so fundamentally different to everyone else that you're saying, I'm going to change the way the world looks in some way and everyone else is wrong and I'm right to go and do that. So that's like a fundamentally very arrogant thing to do. But I think you almost have to have that sort of piece within you that's almost like naively bullish on the idea that you're doing and sort of, I think, pushing back against people who don't believe. So I think that was one piece that I individually, had to come to terms with at the beginning of this year because it was an extremely divisive product. I think when we first came out, like extreme amounts of criticism, people calling me a scammer, next Luna. I probably didn't help that with the commentary I just gave on
to be clear, I did try to throw some fire on top of that.
Yeah. I think for me, it was really just trying to come to terms where, you're trying to do something that you think is worthwhile and you're trying to do it in the right way and just have immense pushback all around. I think that was one piece that I just needed to sort of adjust to. Yeah.
I mean, I would say, look, from my perspective, I think you guys have been like, what was so interesting was that Ethena really came of age. Actually, I think it was in 22, right? That Tom, I think, and you ended up meeting, and he ended up leading the seed round, and that was not long after the collapse of Luna. And in that time, it was a very vulnerable time for DeFi because most people assumed that DeFi was basically dead. That Luna was almost like a what's the term? Like an epitaph for DeFi. That like, okay, these ideas, this almost like this overconfidence that you can create these new financial products. It just shows that it's all a fool's errand and you shouldn't do it. And it was a time. Now, obviously, people think like, oh, Athena's amazing and it's so great. But at that time, nobody wanted to touch stablecoins. People assumed that like, oh, after Luna, how could you possibly want to do something like this again? And I think to your guys' credit, one of the things that you guys did very, very, very well, which was one of the cardinal sins behind Luna, was that Luna was constantly obfuscating what exactly, like how the thing worked and what was risky about it. And one of the things I think to your credit in particular is that you have been always very, very clear from the beginning. There's no way to make yield without taking risk, period. If you're not getting the risk-free rate, it's because you're taking risk. What is that risk? How do we quantify that risk? And how do we absorb and minimize that risk as much as possible? There is nothing in DeFi, there's nothing anywhere that is paying you meaningful yield that is not taking some risk. But as long as you understand that risk and you forecast that risk for people and make very clear to them, look, if you're not looking for this kind of risk, do not buy this product. That is one thing that you guys have done very, very well. And I commend you for, because I think it's a great norm to show to other founders in the space, which, obviously do the first part of the show very much underscoring that. Tom, I also want to give you an opportunity to gas up Guy a little bit. Also, you saw him when he was
I do
a little
that every
baby.
week. Yeah.
Yeah, I know. You
saw
him
behind the show. Yeah.
Yeah,
Exactly.
that's just the service we provide to our Dragonfly founders. But no, I mean, I think I'm very impressed with just how Guy, I think, has navigated crypto as someone who's newer to the space, building a very difficult product, really kind of creating a one of one that, again, people tried in the past, it didn't work. It's a very stressful, controversial category, and I think also just navigating with. I mean, you talk about arrogance, but I think actually you're very low ego in the grand spectrum of all the crypto founders, past and present. And I tell people sometimes it's like there's no secret sauce. It's like you just do the hard work and you put in all the effort and love that goes into building a great product. And if it works, then I think ultimately the market rewards you. And I think you guys have really done that and done all the sort of I think legwork required to make this thing happen. So props to you and the whole Ethena team.
Okay.
Brings a tear to my eye.
I'll just add on, Guy, you're doing great work. I'm excited to see Ethena continue to grow.
Together.
Yeah. Well done. But I mean, look, it's crypto. And so, the number one imposition is do your own research. Make sure that you understand what you're buying and how it works. We tried to give the best exposition that we can for Ethena, but ultimately there's a lot more that we did not cover on the show. So not financial advice. Can't underscore that any more than I possibly could. But at least as far as founders go, I think you've set an example for a lot of people. The cardinal sin of Luna in many ways was overconfidence, and ego was really at the heart of what made Do Kwon. And so I think you've in that regard as well set an example for a lot of founders, is that shut the fuck up, do the work, be really clear about what you're building, and value integrity over anything else. And so obviously we hope that Ethena shows its mettle. You guys have done a tremendous job so far, but there's so much more to do in just making it through the marathon that is building a long-standing product in crypto. But at least for now, very well done, and we hope to see more.
Don't become the main character on Twitter.
Yeah, that's the other big rule, is never become the main character. Usual has unfortunately committed that sin, and we hope that doesn't happen to Ethena.
Who do you think is the leading candidate for this cycle's main character?
I mean, right now, it's Sailor, in my opinion, as like the current market main character.
Yeah, that does not bode well for our Bitcoin bags, but
we'll see.
Okay, on that very ominous note, we're gonna wrap. Thanks, Guy, for coming on and sharing your wisdom, and we'll see you all next time.
Thank you, guys.